morning. You're watching The Market right here in ET Now with me, Ayesha, Faridi, Avanne, Dubash joining in, and it's day after 22K, Avanne.
Absolutely. What a stellar day it was. Life highs on D Street.
Yeah, absolutely. So we made it to that 22,100 plus level, in fact, in the Nifty futures. What a big breakout that we've seen across the board. In fact, it was a broad-based rally if you were to look at it. We'll come to the broader market participation in just a bit, but considering it's the Nifty which has been making all the headlines, what a comeback by IT. A very smart follow-through from the price action that we saw on Friday. Reliance Industries, HDFC Bank, it's the big guns that have been underperforming so far. They finally came back to the fore. In fact, we managed to clock in again for a fifth consecutive session, and the FIIs buying as well has finally resumed after a 4 days break. In fact, the Nifty Bank as well, thanks to HDFC Bank and the kind of weightage it holds within that index, participated just very, very smartly. Nikunj, we were just talking about as to how 22K is already here.
You know, Ayesha, better late than never. That's what I think the story for this year is. Bulls, they started slightly slow. The year started slightly slow, but in last 4-5 trading sessions, the Bulls, I mean, in a sense, the market has really taken what could be called as a giant leap. Whether it is Reliance or a bout of short covering from IT or some price action which is constructive in private banks, it's really the surprise packets, underperformers, laggards, and bout of short covering which has led to the market action. What you could ask and understand is that what's next? So far, so good. We've been on the right side of the earnings season. Now we move into what could be called as the intense part of the earnings season, where we'll hear from mid-cap companies, capital goods, banks, PSUs. So the intense part of the earnings season starts now, both locally and globally. Let's see how markets really navigate that. It's good to see that large cap stocks are leading from the front. You know, the market narrative is suddenly not, okay, you know, Nifty kahin nahi ja raha hai, small and mid cap stocks are moving higher. When Reliance and banks and when you see IT moving higher, the market attention suddenly changes. You know, rather than looking at right, you're looking at left. And for me, that I think is the biggest change in terms of market narrative. Everybody was hoping that large cap stocks should kick in. And large cap stocks are kicking in, and which is also helping the market mood and the market narrative. So if you ask me what has changed between October, November and December and the last couple of days, it's time to say hello to Nifty and large cap stocks.
Yeah, absolutely. And you know, I mean, point to note, what you've seen play out from Friday was largely sentiment, because IT was making a comeback and delivering in line to good set of numbers after an extremely oversold bout. But I think this week is going to be the litmus test. You've got Reliance Industries, you've got ICICI Bank, you've got HDFC Bank and Kotak all delivering their numbers.
Yeah, between them you got what? You actually have more than 35-40% of the total weightage. So it's the heart of the market, which in a sense, the heart of the Nifty, which in a sense would be delivering. And now this time, given that you've seen a run up in large cap stocks also, market expectations are not exactly very low. I don't think we are in for a earning disappointment, but given the recent run up what we've seen, especially in large cap stocks, will numbers be in sync with what the price action has been, or lot of it could be a case of buy the rumor and sell the news? See, banks numbers have been strong for a couple of quarters. Will there be anything different? No. Reliance, I guess this time around expectations in general are slightly high, given how the windfall tax prices have moved, what's happening to the Jio business and how the retail business has moved. And then from Kotak Mahindra Bank, a lot of attention would perhaps be on the new CEO MD as to what he has to share or indicate if there is a press conference. So this week in a sense would be an important week, because if Nifty and large cap stocks have to rally by the end of the week, or hopefully by Monday or Tuesday, we will get a sense as to whether there is more strength in the large cap rally or it will peter out very, very soon.
Okay, yes indeed, it's going to be a very critical week when it comes to the overall earnings. But that aside, can't help but just talk a little bit more about the trade setup as we top that 22K mark. And even when we're looking at the F&O setup, the kind of Nifty positions with fresh longs at 43-point premium, ditto for the Nifty Bank, a 210-point premium, and even the holding in F&O, Nikunj, those trends as well need to be observed.
So what is the F&O market telling you? The F&O market is telling you that, look, a breakout has happened. You have to perhaps trade with a long bias. the open interest is not very large or obese, and even though the put call ratio may look slightly stretched, it is nowhere as high as what we've seen in the previous high. If one really looks at the retail positioning, which is what I always look at, it is more short than long. FI positioning is more long than short. So if you ask me that what is the change, I think the change is that in the F&O market, FIs are long now and retail is still short. And there is one more data, which is we would look at the DI data in terms of where the ownership is, and that is also short. So the local crowd per se is more short than long. And I guess again, just like everybody was in a sense very active in small and large cap stocks, right now also, even though large cap stocks have made a comeback, the market positioning is still very hedged in the large cap stocks. So the margin of safety is still in large cap stocks. I will not be surprised that if large cap stocks or Nifty dominated stocks, if they continue to extend their rally, the market narrative will suddenly, like I said, will continue to be towards large cap stocks. Markets, the smart guys are saying that we want to be in the market, but we want to be in the market where there is margin of safety, and the margin of safety is there in large cap stocks. I think a lot of old timers, a lot of HNI investors, when I speak to, they are doing the same. They're dribbling, they are taking some chips off the table, they are slicing and dicing the small and mid cap portfolio and moving into large cap stocks. And I think it is evident in the way this is moving. So if you frankly ask me from a market health standpoint, if I do like a health check, I think come back in large cap stock and the market action shifting back to Nifty, I think is splendid news.
That should be the strategy for the day, because today it's a much quieter day as opposed to what
you don't go short in this market. That's rule number one. Number two, in the near term, well, I think banks will now, especially private banks, will now hold the key, because IT is already fired. Reliance has given you what it can do, and large cap banks have just in a sense come back in terms of in motion. So I think large cap banks and large cap private banks, frankly, if you ask me, they hold the key. Where I'm actually slightly worried is that, or not worried, I think that in capital goods and defense and PSUs, there could be a bout of profit booking because the rotation has started. So it's not fresh monies coming in, Ayesha. I think the rotation from defense, railways, I think that really is at play right now.
Okay, that's the view coming in and the kind of outperformance as well that we've witnessed in the last week or so. Well, let's hear it out then. Get in some top themes, big market voices on the channel. Vikas Khemani, Milind Karmakar and Gopal Srinivasan talk about the top themes that they're looking at for the year ahead.
We are positive on IT, and I think the execution cycle will only pick up. And I've again said that IT is the best trade on interest rates coming down in US. The developmental spend will come, and as the execution accelerates of the order book, growth will come. We pivoted towards PSU banks because we think there's a big transformation happening, and as a result of that, we believe that PSU bank as a basket would outperform the private sector bank. And it is very natural for something like ICICI Bank, which has become 4x and everybody owns it, so to consolidate for a period of time.
When I'm talking of consumption, it includes finance, it includes pharma, it includes FMCG, it includes retail, it includes hospitals. So all of these would participate and grow significantly because it's very simple. What we are consuming today, maybe 6-7 years down the line, rather what the GDP is today, 6-7 years down the line, we will be consuming that much. So that is the kind of opportunity which, and more, because people will leverage and things like that. So that is the reason why I think that it will be predominantly be driven by consumption, but within consumption, as I said, there are different sectors.
Energy and manufacturing are the two sectors that are beginning to draw a lot more attention. So you will continue to see, in addition to the overall growth, which is infrastructure funding, which we don't directly keep looking at, that energy and manufacturing will be the growth areas in addition to our usual IT, ITES, fintech and healthcare, which is, let us say, the bread and butter of this business, right? To me, I think the sectors that look really super good are the safe ones, which is fundamentally, if you look at financial services, right, there is this digital public infrastructure driven opportunities. I don't think we have really seen more than just the beginning of that right now.
All right, let's take a check of the technical trends and talk about where the market is headed after 22K has hit the screen. Kunal Bothra and Naresh Mirani joining in. And Kunal, are you thumping the table and saying, I told you so, that this would happen, or did this happen earlier than you expected?
Yeah, it happened earlier than expected. In fact, we were waiting for the index to actually get into a phase of correction. But then on the upside, when Reliance started to participate, we changed our stance from 21,700. That was the benchmark or the key breakout level. The moment the index managed to break past about those levels, we were just waiting for the momentum to accelerate. Now, interestingly, in the last, I think 4 or 5 months, September is where we hit that 20,000 mark. When that happened for the index paused for a couple of weeks. I think one and a half odd week, 7 odd trading sessions is where the index paused at the 20,000 levels. We hit 21,000 mark in the month of December. And I think over there also the index took a pause for 5 or 6 trading sessions before we managed to move up higher. So that generally is a phenomena which happens at round strikes because they become hub as key strikes where option writers take a lot of position. Now, interestingly, yesterday we saw some rise in the open interest for the Nifty and the Bank Nifty futures. Now, if we manage to surpass yesterday's high and say scale up by 0.5% more, then we could probably attribute that these are long built up. But if the index manages to doesn't sustain about the yesterday's high by a margin of 0.5%, then we could be looking at the index going into a bit of consolidation. So net, my view is that over the next couple of days, like what we've seen over the 2 previous breakouts of round digit marks, we could be getting into a phase of consolidation.
Naresh, hi morning. Would IT continue to power the indexes?
So I think one by one, once the results are done, we generally see some bit of a pause in the names which have seen a big gap up or a gap down. So the major results are getting done and we'll continue to see result-based action on IT. That's generally been the case in an earnings season for IT names. But the interesting part is the fact that banks could get interesting because still, if you look at the heavyweights like HDFC Bank, ICICI Bank, Kotak, as well as SBI, none of them have actually made a move. We've gone to 22,000 on the Nifty. We are yet to go to 50,000 on the Bank Nifty. We are yet to see a major move. So banks could be the place which could be next in terms of taking leadership.
Right, let's find out those individual stock strategies as well. What is it that our chartists are looking at? So what's the position then, Kunal, given the fact that we are seeing large caps as well participate? What do you make of the markets at these life highs in terms of individual stock strategies?
So I'll go with your mid-cap names over here, and one of the stocks which I've been bullish on, Voltas, continues to be on the buying list, expecting the stock to move up higher by another 4 to 5%. That's closer to 1100 mark is where I would expect the targets for the stock over the near term. Traders who look at a fresh buy at this 1060 mark would look at a trailing stop loss of 1034 on the stock. And the second which I would be bullish on would be KCP Limited. That's a stock which yesterday gave a flag pattern breakout after 4 or 5 days of consolidation. Again, interesting chart, price volume breakout, strong moves from the indicators for KCP. Would suggest a buy with 198 as a target, stop us at 183.
And Naresh, what are the stocks on your radar?
So first is the buy on State Bank of India. The stock gave a breakout above the 620, 630 mark, which was the previous all-time high. Went a little higher, did a retest and has recovered back sharply in the last couple of sessions. So expecting it to eventually make that breakout move towards 700, 750 levels, stop loss at 620. Second is a buy on Syngene. We've seen a good rally across the pharma names. And in this case, Syngene has consolidated well enough, made multiple bottoms around the same base. So bottoming out is done, could see momentum once it crosses 750, 760 levels. So a risk reward trade here wherein a stop loss comes close to 720, target price of 800 plus.
Okay, there you have it. Top stock strategies that are being flagged off. Those are our technical analyst picks for the day. Time to find out the stocks in news as well, and we've got Samir right here with us in the studio to discuss that. And let's talk about Paytm first up then, and brokerages like Axis Capital, UBS as well are pretty positive and have initiated coverage on the stock.
Well, UBS has initiated coverage on Paytm, buy rating, target price of 900. Now, this brokerage note has come at an interesting time. Now, this stock has corrected post the RBI regulations, and now UBS feels that there is still value in Paytm, and the target price is also where about than the current market price. Current market price is anywhere close between 700 rupees, and the target price is 900. Now, what they're expecting is that continued monetization track will continue in Paytm. Along with this, the company will achieve the EBITDA break even very soon. In fact, they're expecting the EBITDA margins to touch 20% 20% level by FY26. Now they're expecting some moderation in growth because earlier the base was low, so the growth for Paytm was much higher between FY21 to 24. If you see the top line CAGR was around 54%, this is expected to moderate at around 21%, but 21% is still a very strong number for Paytm even going forward. And sorry, the EBITDA margin of 20%, their target is still FY28 that they're expecting that will achieve. Apart from that, they're saying that another trend that they have seen in fintech is that for Zomato especially, they're saying that investors are now valuing profitable growth, and that will be the similar case for Paytm even going forward. And they're also saying that the valuations of Paytm, even if you compare with global or domestic peers, it is at a discount. So all these factors combined, they have a buy rating. They have initiated a buy rating with a target price of 900 for Paytm.
Samet, I think what the UBS report is not perhaps factoring in is that after the new RBI guidelines, the entire break-even plan what they had shared, I think that will get extended. Now, a lot really hinges on how soon they can receive their, they can achieve their break-even. See, I don't think there is a challenge in terms of the growth. I don't think there is a challenge in terms of companies' commitment in order to, make it more profitable by cutting expenses. But the fact that post the RBI guidelines, the fact that one chunky part of your business in a sense will not be that profitable what everybody was anticipating and expecting, which led to the decline in the Paytm stock, will the entire break-even target, both internal and what markets are viewing, will that get extended? If Paytm in this quarterly update is able to convince the market that they are on course to achieve whatever they were indicating in terms of their break-even target, I think FY25 is what they had indicated. If
next year.
Yeah, FY25 is what they had indicated next year, the 3 months.
No. So next financial year, FY25.
Next 3 months it will start now.
Right.
So if they're able to achieve that despite what RBI guideline changes have been, then I think the stock is going to rally. So a lot really hinges on that basic assessment. If you frankly look at Paytm in last 1 year, Paytm and Nykaa are two consumer tech and fintech stocks which have just not participated because market really moved. It moved very swiftly from companies which reported profit versus companies which are yet to report profit, and that explains why PB Fintech and Zomato in last 1 year have done exceptionally well. So my whole view on Paytm is that wait for the quarterly number because the management is in the best position to guide how soon they can achieve their profitability. And even if you wait, I guess then it is better to buy post the numbers rather than betting or playing blind in Paytm. I would say it is better to play seen. Once Zomato indicated that we are on course to achieve profit, the stock rallied from 60 rupees to 140 rupees. So it gave you a lot of good entry points because Paytm is a long haul business, but you just have to time your entry in terms of, when and how soon the profitability would be achieved.
And Samit, a lot of hope spinning on HDFC Bank. What can we expect from the earnings?
Well, that will be the key trigger, in fact, even for the benchmark, given that HDFC Bank weightage is anywhere between 13 to 15% on the Nifty. Now, YY numbers for HDFC Bank, we can't compare, but we have to look at the Q1Q numbers, and the NII is expected to grow around 6% odd. Pre-provisioning operating profit is expected to grow up 5% odd, and PAT, in fact, is expected to be down by around 1% odd because of some tax-related changes. But the key number to watch out for all the banks, in fact, and for HDFC Bank is also the net interest margin number. Now, the consensus estimate is 3.6, but the numbers are anywhere between, the analyst numbers are anywhere between 3.4 to 3.9%. Now, the street has already factored in that on a sequential basis, the net interest margin of all the banks are expected to decline. For HDFC Bank, it was 3.62% in Q2. Consensus estimate is 3.6, but there are numbers at 3.4 level also. So if the net interest margin decline is more than what the street was expecting, then again it will be a negative news for the bank. But if the net interest margin is pretty much in line with what the street has estimated, I think no negative could be a positive for HDFC Bank, given the fact that the stock has already has been on a downtrend and has declined a lot from since they have in fact announced the merger, right, Nikunj?
See, I don't think the numbers are going to be trigger points, Amit, for HDFC Bank because last quarter numbers good. The quarter before that decent. 2 quarters before that, okay. So I don't think for HDFC Bank the numbers really hold the key. We pretty much get what is called as advance information from banks in the quarterly update. You know the advance information from HDFC Bank. It's like saying auto companies every month give you dispatch numbers. So you know which way the trajectory is moving. So if you know what growth they've reported, then it's a play on NIMs and fee-based income and other factors. So I don't think it's going to be anything which is going to be out of the box, and it is going to be something which would be market moving because to be in turnaround. The challenge with HDFC Bank is that when will large institutional investors come back and they will say, okay, we love you again as a stock. I think it is that entire relationship which really needs to restart again. And for that, I think it is not numbers, it is really technicals and demand supply situation which matters in the short term. The stock in last 52 weeks has not given any return. So is the elephant getting ready to dance? Of course it is, because it's a safe stock. It is perhaps one of the, I never thought I would say this for HDFC Bank, but HDFC Bank, frankly, Kunal, Ayesha, I think is called as in my book is now as a value trade. I mean, it is cheaper than most of the big NBFCs and most of the PSU banks and most of the small cap banks now. So it is becoming in that value zone. So, it's like saying the elephant is getting ready for the dance. I don't know what would be the right note. Will it be this quarterly number? Will it be post-budget? Or it could be really after 3 quarters. But this stock
you should start buying now if you haven't.
Yeah, and you have to ask yourself is that in this year, what will make you money? In this year, risk management will make you money. Yeah. And HDFC Bank gives you that huge advantage of risk and margin of safety. So if you own it, guys, please have patience. Reliance bhi chala na. So if anybody is expecting that post numbers, you will see like an Infosys kind of a moment and a bout of short covering, that's not going to happen. So that is the point I'm trying to bring out.
Okay, fair enough. That's the very interesting view coming in on HDFC Bank. Thanks very much, Samir, for highlighting those stocks to watch in trade. All right, we take a very quick break right here on the show. Lots more market talk when we return.
Back with the market right here in ET now after clocking that 22k feet. This morning, the GIFT Nifty is indicating a bit of a tempered start. In fact, was down about 53 odd points earlier in the morning today, still lower by about 0.2%. So seems like at least to start off with, you're going to consolidate around that 22k level. But the RBI has issued a draft circular that seeks to harmonize regulations of housing finance companies with that of non-banking financial companies, that's NBFCs. Ankur Mishra, my colleague, joins in with more details. Ankur?
Yes, NBFC, HFCs, that is housing finance companies, have a little different regulation if you compare it with NBFCs, and now Reserve Bank of India plans to harmonize both of them so that HFCs come closer to NBFCs. Now for that there has been certain directions from Reserve Bank of India, and it has been proposed that deposit taking HFCs should maintain 15% of liquid assets for taking public deposits, and this was 13% earlier. Now for NBFCs, this level is 15%, and Reserve Bank of India has prescribed the same level for housing finance companies. Also, housing finance companies needs to have full asset cover that is available for public deposits, and what happens if it falls below that threshold? They have to inform National Housing Bank for that, and if it is short of that liability, that needs to be immediately informed to the regulator. Apart from that, deposit taking housing finance companies should also maintain minimum investment grade rating for at least 1 year for continuing to take deposits, otherwise they will have to stop that. Apart from that, public deposits accepted or renewed by HFCs shall be repayable by 1 year or maximum 5 years as far as these draft guidelines are concerned. Now it will all depend what kind of comments Reserve Bank of India receives, and finally you will see these draft norms taking the shape of final regulation.
Thanks very much, Ankur, for giving us that heads up. Let's connect with Sanjeev Bhasin as well, who's joining in on the show. Sanjeev, what a move the markets witnessed in trade yesterday. Are you saying I told you so?
Yes, good morning, Avanne. Excuse me for my throat because the Delhi cold has caught me. 2.8 degrees, but no complaints. New highs are good enough to make up for a sore throat. Yes, a little bit of froth now, so be watchful. Learn to book your profits. I think the index may have hit a plateau. You could see another 100 points on the upside, but be stock specific above 22,100.
Be stock specific. So give us a little bit more inside strategy, because a lot of the heavyweights now are really pulling their might, be it the likes of a Reliance Industries, hopefully an HDFC Bank, and you do have some of the IT stocks that are making a comeback. And how?
Well, what a comeback by IT stocks and Reliance. And I've been telling you that, market was frustrating the index, but Reliance, HDFC and the IT stocks have taken your breath away. And that puts to rest, never say never to the stock market, and to, believe in what you invest in. I still think there is a lot of room on stock specific. One underperformer has been Kotak Bank. We think that that has started to show very good traction. The results from Kotak may be arguably the best. So we are overweight on Kotak Bank. We are accumulating. We are using this fall in Dixon as also an alternate to buying, because we think EMS is here to stay, and these businesses are not for the next 6 to 9 or 12 or 1 month. They're for the next 10 years. We know that electronic manufacturing services are going to be the mainstay. So Dixon is a stock which over the next 3 years can even scale 10,000. That is one more stock which we have in our portfolio from much lower levels we are adding. And Paytm, I think now the world has woken up and realized that the RBI guidelines were temporary. And, I think that transition will be extremely quick from that sub 50,000 to over 5 lakh. And the margins are telling me that now Paytm is very reasonably priced compared to the other fintechs. So as a disclosure, these 3 stocks are in our portfolio. We are covering these stocks. We think they can be upside. Another stock which I would like to mention is Nalco. This is one PSU mining stock which has moved from 90 to 130, but I still think there is potential to go to 175.
Right, okay, that's the take coming in on Nalco. Today, of course, you've got HDFC Bank, which is slated to come out with its numbers. Kunal, let's map the charts of both HDFC Bank and Kotak. Which one do you think is going to win the race as of now?
So as of now, the stronger one, Ayesha, is HDFC Bank without any doubt, because when we look at the chart setup, the consistency, it's a lot more better. Now, in the last 2-3 months, what was missing for HDFC Bank in the last 1 or 2 years was the correlation of the stock with respect to the Nifty movements. Now, whenever the index moved up higher and moved into a new tangent of a breakout or a new high altogether in the last 6-8 months or so, HDFC Bank remained into its own trading range. But this time around, the last 2-3 months, we've seen that change happening for HDFC Bank, where from the sub 1500 levels, the stock has moved closer to that 1700 odd mark. Very recently the stock managed to break out of the 1700 levels. Now that itself indicates that after a 20% kind of a rally for the Nifty, the stock has also rallied up more than 15 to 20%. So more or less in line performance with the benchmark indices. But then when you compare this with the likes of Kotak Bank, the stock I think made an all-time high of 2,200, 2,150 approximately. It's still trading at some 1,900 odd levels. So that itself indicates that there's been a stark underperformance from Kotak Bank. Now I also like what in terms of data that there's been a long built-up for HDFC Bank. So the last 4 days, the open interest on a broader basis was around 1,74,000 contracts for HDFC Bank. Now till yesterday, the data indicated that the OI for the stock was almost 1.92 lakhs. That indicates that there's been a jump of almost 10% rise in the open interest. So going into results, when we generally expect a rise of open interest, it's generally met with an expectation that maybe the stock would deliver as per expectations or above post results.
Okay, let's move on. And for the first time, Jio Financial Services has revealed its holding company structure with stake in each of the entities. Now this after announcing its third quarter numbers and holding a con call as well. And Vamakshi from our research desk joins in with all the highlights. Vamakshi?
Well, yes, Jio Financial Services in focus today. Let's first look at the numbers that came through for the company. Now, the year-on-year numbers are not actually available, and hence a quarter-on-quarter comparison is actually merited for Jio Financial Services. And interest income actually saw an uptick of almost 45% sequentially, standing at 270 odd crores. But the PPOP, that is the pre-provisioning operating profit, actually dipped by around 40%, and that was mainly on account of dividend income that the company had reported in the second quarter. Apart from that, the net profit standing at almost 300 odd crores saw a downtick of almost 56% sequentially. Now, for the first time ever, the company released the holding company structure with stake in each of the companies. Apart from that, as far as products are concerned, they announced launch of devices on lease and supply chain financing. Not just that, 3 more insurance companies have been added to the list for insurance broking. As far as their debit card is concerned, the soft launch has started. They've also implemented dynamic QR across the ecosystem and also launched app for merchants. Apart from that, they've enabled Jio Bharat phones with UPI, and around 10 crore Jio phones is the market for them. Apart from that, the company also held a con call yesterday, and some of the important commentary from the con call is as follows. They've remained cautious on the recent market developments in the unsecured segment specifically. They've successfully completed testing of consumer durables and personal loans in the third quarter itself, and they also have some products in the pipeline such as loan against shares and loan against property. So largely those were all the important takeaways from the results of Jio Financial Services, and on the back of that, keep an eye on this counter.
All right, thanks very much, Vamakshi, for giving us that heads up. Meantime, Sanjeev, let's also get in your take as to what you make of a Paytm. Positive brokerage notes coming in, a complete thumbs up from UBS. They're talking about a target price at about 900. What's your view?
Well, I guess they got influence seeing ET now and me covering it for the last 2 weeks when I said this was a one-off of the RBI guideline, and the knee-jerk reaction meant that some of the short-term people got out. I think it's an opportunity, not 900. I would say 1200 is coming in Paytm in this year. I think that transition is fast. Their EBIT margins will be better than expected. And like I said, it trades at the cheapest multiple some of these fintechs trade at. So we have as a disclosure, Paytm is in our portfolio, and we will add more closer to 650, and we think it will cross into 4 figures in the next very, very near future.
Sanjeev, look after that throat of yours, and we'll chat tomorrow, hopefully when your throat gets better. But that, of course, is the take coming in on Paytm as well. Of course, it's really been all about IT. And, you know, Kunal, if you were to take a look at the constituents, well, Friday what instilled the move was, of course, earnings from Infosys as well as TCS. But you've been more bullish on Wipro as well as HCL, right? And Wipro was the one which was leading the charts yesterday, as also HCL Technologies too. You think still you would go for these 2 names as opposed to TCS, Infi or any other mid-caps?
So I'll be more particularly bullish on the large cap IT names. So yes, Wipro and HCL Tech were the 2 stocks which you highlighted. Even Infosys, I think, was one of the few ones which had been a huge underperformer which looked quite promising on the charts. The stock had not gone into that sharp selling pressure which everyone was anticipating. But looking at the charts, there was a lot of support, much higher supports and higher demands for the stock, even at a point when the stock was at 1500, 1550 points, and then gradually moved up higher. Now, what has actually happened is that typically after such a kind of a strong uptick, where gaps get created into these stocks, and these are rare upward gaps which you've seen for the large cap IT names, as compared to the last 2 quarterly results, where I think Infosys, if I'm not wrong, twice had given a gap down approach for itself. So that indicates that there's been a change of approach which now could happen for the large cap IT names, and that could be a precursor of a bigger trend in the making for these large cap IT stocks. So maybe not from an immediate perspective that for the next 1-2 weeks we may see a strong big follow through up move, but then slowly and steadily I would believe that trends could probably be in play for many of these large cap IT names. I think if these stocks drop down, say, by a margin of 3% to 5% broadly from their 2-day, 3-day swing highs, I think that could be a very good entry point for large cap IT stocks.
All right, let's get a move on then and put the spotlight on Jyoti CNC, all set to hit the bourses today. Let's take it across to my colleague Lisa, who has all the details. Lisa?
Right, so Jyoti CNC will be listing today, and analysts are expecting that it will be at a premium of around 13 to 14%. Talking about the IPO bit, the price band is at around 315 to 333 per share. The issue size is at 1,000 crore, and it is a fully fresh issue for around 3 crore shares. There is no component of offer for sale. Talking about the company a bit, it was incorporated in January 1991, and it's a leading manufacturer of metal cutting, computer, numerical control CNC machines, and they also export to countries like Romania, Poland, France. They have a capacity to manufacture around 4,400 machines per annum. And the clientele also includes marquee clients like Rolex Rings, Bharat Forge, ISRO. And the objects of the issue that partly they'll be utilizing it to pay off their debt and also for funding their working capital. Major portion of their revenue comes from aerospace and auto, but they will be delving more into the EMS, which is a high margin segment. So that was on Jyoti CNC, which will be listing today. So to keep an eye on that.
Time to say hello and good morning to Devin Choksi and Reliance. Devin bhai?
Yes, Nikunj, good morning.
Sawal to tha Reliance. I have to prompt Reliance and I expect an answer. Kya ho gaya achana? What's changed suddenly?
No, nothing has changed. I think Reliance is coming with the result on Friday. So I thought you will ask me on next Tuesday.
You think numbers will be strong? Are we in for a beat?
Yeah, I think in all seriousness, I think this quarter should be working good for the company. On one side, they have had the advantage of lower crude oil prices, which normally I think they buy in discount. I think in this quarter, they are like to get slightly more advantages on this particular front as well because of the lower prices. So the industrial business of refining petrochemicals and polymer business is expected to show the growth both on the demand side of the situation as well as I think on the cost side. On both sides, this business is likely to show relatively stronger set of numbers compared to previous quarters. Then comes the consumer-facing businesses, Jio Financial, Jio Platforms, and the Reliance Retail. Both these businesses are growing at a steady pace of around 19 to 20% in individual verticals. And that is where, again, I think you're going to see steady set of numbers. Jio Platform, as it stands today, is about 120,000 crore top line with 60,000 crore worth of EBITDA making proposition. And the situation for the Reliance Retail rather, I think is going to be equally strong with somewhere around close to 3 lakh crore worth of revenue book. And I think the corresponding profit around 7.5 to 8% EBITDA level. So certainly, I think both these verticals looks equally interestingly positioned. So Reliance certainly looks number-wise, if you look at it, this quarter should be a good quarter. We'll all have to wait and see the announcement pertaining to the renewables, which is expected to happen in 24-25 financial year.
44 points down for the Nifty spot. That's perfectly okay. I don't think anybody is going to be really complaining there. Naresh, a stock which is worth revisiting, and we'll be talking to the management also a little later, is Raymond. not at a 52-week high, but a big surge yesterday, and it closed almost at the highest point of the day. Do you think Raymond is looking good for more?
So after the correction in the last few months, the stock went through a sideways phase for the last almost a month. So technically, it went through that consolidation and it was in a very tight range. And yesterday was a price volume breakout. So that indicates a short-term momentum breakout is done. Now, in this case, we need to watch out whether it can go back to that 2150 mark, which was the previous high, or take a pause before it. So the risk reward is good here. One could keep a stop loss at 1750 and expect a move towards at least a 2000, 2100 mark.
Another, now what do we have on it? Bandhan Bank. As per December 2023 data, HDFC Bank shareholding has fallen below 1% of they've completely exited from Bandhan Bank. You know, Bandhan Bank has been a marked underperformer. Until the time we don't get real clarity as to, you know, what essentially the impact of the audit would be on them, I think in the near term it will remain, markets will remain nervous. Now, HDFC Bank does not appear in Bandhan Bank shareholding. So, now what's Bandhan Bank got to do with HDFC Bank? It's largely because of the merger, and Bandhan Bank and Grove Finance were there, and HDFC Limited had stake in Grove Finance, and Grove Finance had stake in Bandhan Bank. Because of merger, everything came together. And HDFC Bank, in a sense, they had to reduce the ownership in Bandhan Bank because one bank cannot have investment in some other bank. So over the years, Reserve Bank of India gave them time to reduce it, and I think the shareholding has come down. Now, optically, what this means is that one large supply which was coming for Bandhan Bank is over. But till the time markets don't get convinced about the recent audit concerns which have come for Bandhan Bank, I think in the near term, this is a stock which could remain under pressure. And even by this, in a sense, has been a stock where I would say that there was a lot of promise, great brand, but they have consistently disappointed the market. Anything goes wrong in that in the geography which they are in, which is West Bengal and Assam, they tend to take a hit.
I think my understanding on this particular business, they are most vulnerable to the situations which are there in the respective geographies, which you rightly hinted in the eastern belt of the country. Probably, I think this is where I think the challenge would be to pick up such kind of companies which are not having the pan-India presence, but which are having the local presence. So on one side, I think they address the customer segment, which is relatively the weaker segment of the customer. On the top of it, I think you are extending the unsecured loan to them. And then the situation comes in a given situation, I think in the recovery related issue happens. I think that is where probably you get the maximum hit. Earlier days, I think most of the corporate banks, I think when they were struggling with their fintech platform, they were unable to expand their reach. Now today that situation is gradually receding, and most of the corporate banks with the digital reach, including through mobile, is now having pan-India presence, I think, to the local customers. And they are far better off in having the cost of funds under their control, and at the same time, I think, assessing the credibility of the borrower at the same time. So to a greater extent, I think the businesses which assess these, or the investors who invest in assess these, they've systematically, I think, started looking at more promises in the larger banks who are having the ability to expand the reach. That means, I think, to fill up whatever the advantages which SFBs would have, they would have that ability. At the same time, I think they've already started disrupting the market by way of extending the microcredits also in some pockets. So in my viewpoint, I think the premium valuations which the SFBs have got, probably I think that were to come into some amount of pressure at any point of time, and which is what we are experiencing in the marketplace at this point of time. I believe that I think larger the size of the bank, that would be the better advantage for investors going forward.
Report from JP Morgan on telecom, and they are making a case that upgrade Indocent Tower to overweight and Bharti to neutral. Peak 5G capex is behind us. As Jio and Bharti are close to achieving their targets, and the focus would now shift to recovering ROIC momentum, free cash flow, and deleveraging. Then there is a lot of logic in what JP Morgan is now perhaps advising to the clients, that go and buy telecom. Bulk of the capex is over. Now you've spent and you've constructed the 5G towers and 5G technology. Indians, for us, our data consumption is going to increase, and for a telecom company, when the capex cycle is over And when that has typically happened, that always has led to a huge boost in profitability and return ratios. Do you think a stock like Bharti is at the cusp now, where next 12 months will be better than the last 12 months?
Obviously, one would like to think that having completed the CapEx program, the next move would be to improve the balance sheet. And for improving the balance sheet, two aspects are to be taken care of. One, obviously, I think the leverage part of the balance sheet, how systematic I think we can bring it down going forward, because the larger part of the CapEx is over in implementing the capacities under the 5G. On the other side, I think the revenue book has to increase. And that is where the eyes would be on. Actually, Street is keeping a very close eye on how exactly the revenue book will increase for the data packages that are being sold by these companies. In my viewpoint, I think more number of applications coming under the 5G, more number of applications coming onto your mobile devices would mean higher amount of data consumption. So on one side, volume increase, and on the other side, I think if they end up increasing the price, then it would be a sweetener. In my viewpoint, I think both Bharti as well as Jio, I think are sitting on a huge amount of potential, which is going to be an upside going forward. So if up till now we have seen the growth of around 20% in the kind of business, quite possible that Jio platform kind of companies would end up providing a growth, I think in excess of 20% to 25 to 30%, given the fact that I think they are also reaching out to the enterprise through the air fiber, and the homes also through the home air fiber. This kind of proposition, along with the higher amount of 5G rollout, could possibly bring higher amount of growth into the business of the company. So eyes could be certainly onto the telcos, and both Jio platform as well as Bharti are looking interestingly positioned.
Another interesting brokerage note this morning is Morgan Stanley's view that's come out on the entire auto sector, saying that while the overall industry growth has moderated, EV growth is only going to accelerate, and supportive policy is also going to be a big tailwind when it comes to earnings. So they're bullish on a lot of the four-wheelers. Tata Motors, M&M, Ashok Leyland are some of the preferred bets, but they've downgraded an Ayesha Motors. Devin, what's your assessment on the EV growth, companies capitalizing on it, commodity prices, as well as the earnings?
Well, I think on one side, the industry is experiencing fantastic times, both in passenger vehicles as well as in commercial vehicles, and of course now in the two-wheelers as well. One is experiencing higher amount of growth from the consumer. These numbers, I think, up till now, I think, have not been seen, and now sounding good music to the ears, where I think we are talking about 5 million vehicles kind of a market which India has created. So to a greater extent, I think we are relatively, I think, more comfortable position. Now, between the IC and the EV, the good component is that EV, the cost of production is systematically coming down. Up till now, the EV hasn't been making profits. I think that is where probably you are now likely to see the situation of profit coming in, because the cost is coming down, including the battery cost and battery management systems, which are coming up now. They are likely to save the EVs, I think, from the higher cost, and probably give them the better opportunity on the side of, I think, the volume pickup, which is now likely to happen in a systematic manner year after year. So we remain distinctly confident about auto. Higher amount of spending by the individuals because of the higher per capita income. This is also another good sign, and that's where probably I think one remain bullish. Within the space, I think we feel that commercial vehicle is still underpriced, and probably most of the commercial vehicle stocks shows distinctly high amount of growth trajectory. So one could remain positive in that space, I think, more than other space at this point of time within auto. Of course, auto ancillary remains, I think, the choice because of the higher amount of integration most OEMs are doing with the ancillaries. That's where probably likes of Minda, likes of Minda Corp, among others, I think, are looking relatively much better into the portfolio for investors.
All right, stay with us. Let's also focus in. We've got a very special guest, Vikram Shah of Shalby Hospitals, as he shares his entrepreneurial journey, talking about how Shalby Hospitals has redefined joint surgeries. Stay tuned for that episode. Here's a sneak peek.
In India, knee surgery was considered to be a dangerous affair till about 20 years ago, till the time Dr. Shah made it simple, affordable and effective. you've done the highest number of surgeries in the world. Will I be incorrect or will I be correct?
Absolutely.
You've done the highest number of
Yes.
surgeries in the world.
Yeah.
How many surgeries have you done?
1,50,000 knees and hip and shoulder replacement.
ये carbs है तो प्रोटीन ऑर्डर करें क्या क्यों मिलते हैं से ये तो carbs लग रहे हैं
We are carb
मेन्यू लाए
lovers.
भैया प्रोटीन ऑर्डर करना पड़ेगा
We are carb lovers. We Indians are carb lovers.
Okay.
So we need to cut down on carbohydrates.
सपोज कोई पेशेंट को हमारा शो देखना है ओटी में आप क्या बोलेंगे बोलो डॉक्टर वो जो अपने शो कराते 18 आवर पे वो सर्जरी के समय दिखा दीजिए तो आप क्या करेंगे
चालू करके तेरा आवाज सुना दे
Looking at the Nuresh, I'm looking at the list of stocks which are in FNO ban, and that list is, I think, almost like 1 dozen plus now. For our viewers, can you explain it to us that if there are so many stocks in the FNO ban, what does that mean?
So the problem is not just the ban. There is participation increasing on the derivative side of it. But the fact is the limits which we have in terms of market-wide position limits in India. So if you look at it, the calculation at 30x of the delivery volumes on a daily basis or 20% of the free float, that implies you have roughly 5 to 10% of equity in most cases, which can be done. And in that, you have 60% of that open interest to be options. And we've seen options go up in a major way. And it gets calculated on a notional basis. So wherever there is a little bit of speculation happening, and if it's a smaller company, it gets into the ban. You don't see a Reliance Industries going into a ban. It's the smaller ones where there has been a lot of momentum, etc. And to add to it now, thanks to taxation, the only fund which has lower taxation is the arbitrage funds. Arbitrage funds have gone up from 80,000 crores to almost 1.4 lakh to 1.6 lakh crores. So what we see in a lot of names, you have arbitrage funds which have a sizable part of the futures OI. So overall, net, I would not look at it in the same way. And also the fact that earlier pre-COVID, the rule was you could not roll over. You could roll over positions even in a ban. Today, you cannot. So that creates a problem in terms of trading. But I don't see it as a major speculation increase. But the case where there are very strict limitations, unlike what happens globally.
Metropolis is in FNO ban. Wow. Indus Tower is in FNO ban. Hind Copper is in FNO ban. Z, I can understand that has been very volatile in terms of calling out, especially because of the news flow. Bandhan Bank is in FNO ban. BHEL, Biocon. Kunal, very unusual names, right? Yeah. Metropolis, Biocon. These are not the stocks which typically go into the FNO ban. What does that mean? I mean, Nuresh gave his interpretation, but what is your interpretation?
Yeah, I think it's very similar that, right now, in the case where many of these stocks which have been beaten down, so for example, Bandhan Bank, you look at the last 1 week, you look at Z in the last 1 week, you look at many of these stocks, Metropolis in the last 1 week, many of these stocks have gone through a correction going into the FNO ban. That generally is an indication that, traders are looking at a range-bound kind of an action into these names. Delta Corp has been one of the stock. The stock has been stuck at this 150 mark, say plus minus 5-7% odd range for the stock. So there are many of the stocks which go into FNO ban. The trends go amiss for these stocks, and they generally enter into an FNO ban, with a slight negative kind of a price participation for these price trends for these names. I think that's a bigger concern for these stocks, because even if these stocks are going through an uptrend, for example, Biocon had a fantastic uptrend going into the last, I think, 1.5-2 months. It came very close towards that 300 mark. Now that the stock is in FNO ban, I would probably believe that the stock trend on an immediate basis could be hampered, and you might see the stock actually going into a correction. So that's generally the aftermath of stocks which generally comes into an FNO ban.
Okay, so you're saying something important, Kunal. You were saying that let's look at a list of stocks which are in FNO ban. There's a long list here, about 15-16 names.
Correct.
If a stock moves into FNO ban, the only way it will come out is that if the commitment reduces. And if a stock which has been an uptrend, it comes in FNO ban, that means somebody will have to sell.
Yes.
Which means stocks which are in FNO ban, in the short term, they could go down.
Correct.
Whether it is Z, whether it is Biocon, whether it is Metropolis, whether it is
you look at all the stocks which are there in the FNO ban, Delta Corp, Bandhan Bank, Metropolis, I've forgotten the names of the stocks.
Chambal.
Chambal Fertilizers, Delta Corp has been one of the other stocks.
Viresh, that's an interesting point that stocks, when they move into F&O band, the near term, the direction is down rather than up.
Yeah, so for the next few sessions, because the only way any trade which happens, it has to be a square off mode. Unlike pre-COVID, before COVID, you could just roll over the position to the next month. So out here, over the next, at least what I have seen in the short term, for the next 4 to 7 sessions, at times there is a dip. But if we notice, all those 15 names are companies which are lower in market cap. You don't see the top 50 or 100 names which get into the band. So out here, the participation is a problem because of lower float relatively. But we've also seen some of the largest move happen in names like Hindustan Copper, which was in band. We had BHEL, which continued in band. We've seen all the metal names like Nalco Sale remain in band. But one thing is very clear, these are smaller names in terms of size from the overall universe of F&O names. So it becomes a difficult problem for traders because you suddenly the liquidity just goes off. So you have to cut down positions at times purely because the margins also go up.
Devin bhai, how would you approach Polycorp? Everybody had a view last Friday. What is your view? I want to understand your independent view.
So Nikunj, I believe that the fundamentals of the company haven't changed much. Yes, I think some of the things which have come out and which is yet to be confirmed by the company, I think they reasonably sound serious. Of course, I think that needs to be clarified by the company. That's what I would like to hear first from the company. But keep that part aside for a while. I think the stock has significantly corrected on the valuation. This is a company which is constantly, I think, building the capacity and participating into the building material segment, where the growth remains on a higher side. I believe that I think given the kind of expansion benefit that we are likely to see in the next 4 to 8 quarters, I think this is where we are likely to see 25 to 30% kind of a growth for the previous year's business from this company. And that's where the valuation comes into play. Prior to this, the valuations would remain at an elevated level of around 40 to 50 times price earning ratio on forward basis. Today, the valuations have come down to 33, 35 times price earning ratio on a forward basis. So to a greater extent, that comfort is now available. If the company is growing at around 30% plus rate of growth and the valuations have come down equal to the growth, that means that I think it's a time probably to look into this company from investment point of view than otherwise. If there are many negative surprises left, I think then one will have to listen to the management first. But management has categorically denied so far. So to a greater extent, would like to go with whatever they have disclosed. I would believe that I think the current level of valuations, they suggest that I think one can buy so gradually and with more clarity at full hog, I think one could buy into the portfolio. Business remains absolutely convincing as far as I am concerned.
9 a.m. Let's check in on those pre-open rates after yesterday's stellar move at 22K, where the pre-open rates settling at, well, around the 21,100 mark as of now. For the Sensex, though, we've tempered off about 460 points in the red. Those are the pre-open rates this morning. Let's find out those mid-cap strategies as well. What is it that our chartists are picking out as their mid-cap calls? Kunal, what's looking good?
So I'll go with the buy on Landmark Cars. That's a stock which yesterday gave a inverted head and shoulder breakout on the short-term charts. It's almost like a 40-50 pointer pattern for the stock, and the breakout is around 840 marks. So would suggest a buy with a target of 880, stop aside 820.
Right. Naresh, what about your mid-cap strategies?
So that would be a buy on Taj GVK Hotels with a stop loss at 240 and a target price of 280. The stock has consolidated well. Had seen a sharp correction in August, September, and has not recovered back to the previous all-time highs. Majority of the hotel names have made new all-time highs. So there should be a catch-up in this one over the next few sessions.
Okay, fair enough. Meantime, it's interesting, Devin, that the rise in spiritual tourism, particularly with the Ram Temple, has seen a lot of demand coming in a lot of these places, and the hospitality companies are capitalizing on this. How would you look at this as a trigger for a lot of hospitality companies? What's the view on the space as a whole?
Evan, I think this is a fundamentally very important point of view from the country as a whole. On every side, I think you have got different kind of spiritual places. In fact, as we talk, India has got about 35 lakh mandirs across the country, and small and big mandirs. And most of these bigger mandirs are getting transformed into the bigger places, including the Puri temple in Orissa or Mahakal in Ujjain, or for that matter, the other ones, I think Varanasi and now Ayodhya, next would be Mathura. So all these new temples are actually, I think, reviving the economy of those particular places where probably these new structures, new places of worship are coming up. In my viewpoint, I think easily 15 to 20% of India's population is dependent on, I think, this kind of economy that we are basically talking about. As I call it, it's a mandir economy, which is, I think, feeding about 15 to 20% of total India's population directly or indirectly, who all are there in the ecosystem. So this is going to be an important move as far as the country is concerned. And certainly those companies which are catering to these businesses, they are relatively going to have more opportunities. Like in Ayodhya, the state government has issued about 100 applications for setting up 5-star hotels. Government is talking about investing 85,000 crores of rupees in 10 years' time into this place. I think most of the companies which are focusing on these spiritual places and the surrounding areas therein, I would think that I think they would have relatively better times, be it IRTC or even the newer ones. I think the Pravek kind of company which has entered into the tent city kind of a business. They are some of the interesting looking propositions from the investment point of view. Of course, the stock prices are adequately and fairly priced today, but maybe I think corrections in the price would be a good opportunity to add into the portfolios in some of the names.
Okay, Devin, great to have you on the show. Thank you so much for joining in today. Good chatting with you. Let's also tell you, while what the pre-open rates are settling in at, and it seems like it's going to be a flat start at least, but you know, who knows where we pick it up from there. But here's what's happening outside the world of equity markets.